Kicking off the week on an up note. 30 minutes until the start of cash trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, Trump's search for a Treasury secretary has devolved into disarray over the weekend, with contenders tussling for support.
Meanwhile, Tesla shares spike on a Bloomberg scoop that the Trump team wants to ease rules for self-driving cars.
And all that comes ahead of a big earnings week with Nvidia and more retailer results on deck. All of that and more coming up. But let's take a look at where markets are trading 30 minutes until the bells ring. Of course, we're up a little bit. We had a pretty big down week last week. The S&P 500 falling by 2%. The Nasdaq 100 down by 3.5%, actually. A little bit of green to start this morning, but tepid gains overall. And then you take a look at the bond market. The bond market has held its sell-off over the past couple weeks, even as some of those Trump trades reverse in the stock market. The bond market currently higher by about 2 basis points on your 10-year Treasury yield, knocking on the door of 4.5%, Matt Miller.
All right, I'm taking a look at Nvidia. Dan Curtis, our London producer, put together a really cool chart. Now, in blue, you see the Nvidia share price. In white, you see the PE ratio, forward-looking PE ratio. I think it's great that as they put out better and better profits, the PE ratio continues to come down while the stock keeps climbing. We'll see if that happens again on Wednesday as we get geared up for Nvidia to report.
We're going to watch some stocks moving pre-market as well while we wait for that Nvidia result. Tesla higher after the Trump's transition team told advisors that they plan to ease U.S. rules for self-driving cars. You now have Tesla up about 6.6% pre-market. Also watching Liberty Energy, also surging after Donald Trump nominated the company's CEO, Chris Wright, as Energy Secretary. Liberty coming out this morning announcing a new CEO if he does get that confirmation, of course. Liberty now up 5.7%. This is a $2.7 billion oil field services company. And as Matt was talking about NVIDIA, it's actually down 2% this morning. That's on a report that they're asking suppliers to change the server rack design for the new Blackwell chips. And remember, as we've been talking about, that big earnings report on Wednesday is really one of the bigger moments of the week.
Too hot. The servers get too hot. They need to be redesigned. Apparently, they're gigantic. Those servers, with all the GPUs in them, are taller than your average refrigerator and weigh 3,000 pounds. Which I think is appropriate because they probably cost like $1 million. Katie.
You know what else also got a little bit too hot?
The S&P.
I'm talking about the S&P
500.
500. I want to look at the 1-month view of the S&P 500. It's pretty amazing. It's the similar chart, too, if you take a look at the Nasdaq 100 as well. Hopefully, we'll pull it up. But over the past month, the S&P 500, we're still higher than where we closed on Election Day. But remember that huge rally that we saw the day after? We're now below that. All of these Trump trades, this enthusiasm that we're seeing, starting to eke out of the market, especially as traders question whether the Fed is really going to deliver when it comes to that rate cut.
One of the worst performers in that time, I think, was interesting. It was real estate. Interest rate sensitive. But actually, what I think is also interesting is the worst sector performance is actually healthcare. Remember, a lot of those vaccine makers last year dropped after his pick as Robert F. Kennedy Jr. for Health and Human Services Secretary. So policy is made by people, and of course, the sectors are reacting to it.
Yeah, here's the chart that Katie was
really
referencing.
Gentle hill. You can see
I thought, when you first said this, I thought, well, it was up 4% after the election, and then came back down, but still we're up 2%. But you made a great point, which is that we haven't gone higher than November 6th.
Yeah.
So we're still there.
There was only one day where we closed about over 6,000. That number that we spent all that time talking about.
Well, we'll continue.
Only one day.
We'll continue to focus in on it.
One
way
number.
You could make those gains better is by pairing your S&P purchase
what a great idea.
with a sell of the Euro Stocks index. And that's just what Lucy Baldwin did. Let's bring her in, global head of research over at Citi. Lucy, you put on that pair trade apparently on Election Day. Is that a long-term view? Is that a tactical play? How do you see it?
Hi, Matt. Great to be here with you. Thanks for having me. Yes, you're right. As you're discussing, right, there's a lot of policy uncertainty now that's playing out. And I think part of the reason we obviously put that initial trade on to be long US stocks, short European stocks, was exactly predicated on many of the themes you're talking about, i.e. the risk of tariffs, the risk of US exceptionalism continuing, etc. But what I would say is that is no longer our key trade. We've just recently upgraded from an asset allocation perspective, Europe, to say that you actually should barbell it now. And let me tell you a little bit, Matt, as to why we think that's the case. If you think about the policy uncertainty everybody's grappling with now, post-election, you've got four broad buckets. You've got the sort of more negative growth, risk of higher inflation policies around immigration, but, and obviously the impact that a reduced supply of labour markets might have on inflation. People are trying to grapple with that, understand what that looks like. And obviously the tariff piece, is that very broad or is that very narrow? Again, the risk that that's a negative shock to the US. And then offsetting that, you've got the much more pro-growth policies around deregulation or a regulatory reset. And again, within the US market, there's an awful lot of opportunity, I think, still in equity markets when you think about how that's going to pan out, even with the moves we've had, particularly if you look at financials, if you look at climate and energy, if you look at the sort of broad antitrust agenda. So there's opportunities there in the US. And then the sort of fourth bucket, I think when you add all of that up, is going to be fiscal. So although we still like the US, we've actually just upgraded Europe because we think actually right here at these levels, there's an opportunity for that barbell approach.
Right. So, Lucy, it sounds like that was a trade. Let's talk about investments going forward. You mentioned fiscal as well, and I want to talk about the potential pick for U.S. Treasury Secretary. Obviously, all eyes on Wall Street are trained on Mar-a-Lago right now, trying to game out who will actually get the job. You write about Scott Bessent in your notes saying that he should prevent the worst on the rate side. How disruptive could it be if it wasn't a Bessent, if it was maybe one of these other contenders, some of these names that have been floated over the weekend?
Yeah, look, I think to your point, right, you've seen quite big moves in the back end of the curve since the rate cuts in September. I think the back end of the curve's up around 85 basis points. There's that risk of higher inflation, higher rates. I think, as you pointed out, the Bessent scenario, people felt that he would be very careful on the deficit, right? And so he wouldn't allow that perhaps to continue to balloon, despite obviously the concerns around that elevated fiscal spending, i.e. not just the extension of the 2017 tax cuts, but also obviously the potential for corporate tax cuts going down to 15% and a whole range of other things. People thought he would be quite careful offsetting that with other things, including raising revenues from trade and also things like slashing the government spending. And there's clearly an agenda that we've seen with Musk and Trump's comments around being quite radical and disruptive, thinking about that. In fact, one of the baskets that a lot of our clients are really interested in is looking at names in Europe that might be exposed to US spending cuts as we go forward. So I think to your point, if we don't go down the route of having someone who's going to really balance the books, there's going to be a lot of questions asked around that fiscal sustainability and around US government debt and who the next buyers for that are going to be and how much further the back end of that curve could move.
Lucy, what about some of these other nominees put forward by the president-elect? Because you look at Chris Wright for Energy Secretary, RFK Jr. for the Department of Health and Human Services. When you look at some of these nominees, how much do you have conviction or lack thereof in certain sectors? Would you advise clients to put those trades on now?
Well, I think what you have to do is have a broad, diversified portfolio here because that policy uncertainty, the magnitude, the timing, the sequencing is still very unknown until you know who's in the key seats and what those policies are, right? And a good example of that is obviously trade. We don't know yet whether it's going to be very narrow and targeted, for example, just towards China, or whether the trade policies are going to end up being much broader, much more all-encompassing and might target a number of countries. And that can obviously have a series of fairly negative demand shocks, not just in the US, but for the rest of the world. So when we're talking to clients, that's why in equities, we actually now like this barbell approach of being long both the US and Europe in equities. We like within credit, for example, high yield. We think there's still opportunities in government debt. I think there's a much clearer path to rate cutting that we and others see for the ECB, given some of the structural pressures in Europe. Obviously, there's already an element of of pullback that the market's expecting in terms of how much the Fed can cut from here as we go into next year whilst this uncertainty remains. So I think having a broad, diversified portfolio is really important. But even within the US market, where our bull case for the S&P is 6,100 currently, we're still working through what is that magnitude of growth that you can see from US stocks next year. It's probably high single digit. So that's probably going to mean your upside to US equities next year is going to be high single digit, maybe 10% max. It's not going to be a repeat of this year's performance. Hence that view. It's not just about big cap US tech. Right. You probably want a broadening approach to encompass more stocks in the US that are going to benefit from a series of different policy changes in different places, as we said, whether that's deregulation in certain cases or other things, so that you're exposed to more alpha opportunities across asset classes. And I think that's going to be really important as we head into next year for clients.
All right, Lucy, got to leave it there. A really thoughtful way to kick off the trading week. That is Lucy Baldwin of Citi. Meanwhile, we check on these broader markets right now. You can see a little bit of a rally underway, and I stress a little bit. The S&P 500 up about 0.1%, a little bit more if you take a look at the NASDAQ 100 and the small caps. But let's look under the hood right now. We'll do that with Abigail Doolittle.
Well, one stock helping those index futures, at least the S&P 500, and I believe the NASDAQ 100 super microcomputer SMCI right now up 9.8%. This basically after this wipeout fall from the recent high of earlier this year, down more than 80% on accounting fears. Well, today is the day where they either need to file that delayed 10K that has caused so much of the selling announced back in August, or they need to file some sort of motion with the NASDAQ to stay on that exchange. Some sources are saying that the latter is more likely. Either way, there seems to be a little bit of a relief rally. Turning to the shares of Astera Labs, another chip company, we see, well, Merrill Holdings, it's down 6.4%. This after Bitcoin is still above $90,000 per dollar. However, off of the highs, the technical's pretty stretched. So maybe some investors taking chips off the table after the massive rally for these crypto stocks. And now Astera Labs, I believe we are going to see a nice gain for this chip company, up 3.8%. Citi has initiated with a buy. They are saying that this stock and company offers a unique AI opportunity, that the PCIe retimers are used in a lot of AI servers. And you can see shares responding in a positive way, Matt.
All right, Abigail, thanks very much. We're going to focus in on, obviously, because NVIDIA reports, we're going to focus in on the spending at data centers. A lot of people are folding in crypto to that AI play, right? I think it was Moody's that said they're going to spend $2 trillion, or we are going to see companies collectively spend $2 trillion.
Well, you think about NVIDIA used to provide those chips to crypto miners. That used to be its business, and then it was AI, and maybe now crypto is coming back into vogue. But
as we've been following it so much, that's why so many people are investing in the infrastructure play around those data centers as well. Maybe a little cleaner of a trade.
Exactly my point. We're going to focus in on that story later on in the program. Also, MicroStrategy spending $4.6 billion to buy Bitcoin. Does that company have a company, or is it just they just buy Bitcoin? It's
nominally a software company.
All right, coming up, Trump's picks for Treasury Secretary are, well, that pick is the one that is really left, and getting more complicated. More on the runners and riders for that role next. This is Bloomberg. Let's get now to high interest to look at what's making headlines around the world. Hundreds of HSBC managers have been asked to reapply to keep their jobs. People familiar say the interviews are already underway for HSBC's newly formed corporate and institutional banking division, CIB division. Job cuts are expected to be announced in the next couple of weeks. So good luck. Spirit Airlines has filed for Chapter 11 bankruptcy. The budget airline has struggled in the face of competition, and mainly because of its failed deal with JetBlue, the government nixing that. It lists assets and liabilities between $1 billion and $10 billion. Spirit has reached an agreement on a broad debt restructuring with the majority of its loyalty and convertible bondholders, and that will zero out the shares, which I believe are no longer traded on the NYSE. New York City transit officials are meeting now, and set to vote on a revised toll program that would charge most motorists $9 to drive into sections of Manhattan. The toll is set to start in January. The fee will rise to $15 by 2031. New York Governor Kathy Hochul wants to push through the congestion pricing policy before President-elect Donald Trump, who opposes the fee, takes office. Sonali?
And we're now looking at the incoming administration's picks for press secretary, energy secretary, and the FCC, all set. But the president-elect has not picked his Treasury secretary yet. It was expected last week, but over the weekend, instead of narrowing the search for a final candidate, the search fell into disarray, and the former president is reportedly getting irritated at the jockeying going on behind the scenes. Anne-Marie Hordern, who is all behind the breaking news, Bloomberg's chief political correspondent and co-host of Bloomberg Surveillance, joins us now on set. Two main questions for you. One, is this jockeying going to ruin Scott Bessent's chances to take the helm at the Treasury? And also, Mark Rowan, what a dark horse.
True. Okay, so first question. With Howard Lutnick now basically, as sources are telling us, being offered maybe an off-ramp. They're looking at where else he can go, maybe an ambassadorship, something that is fancy, maybe the Court of St. James, something along those lines. If he was able to take that, does this mean Scott Bessent could just rise to the top? Or is this fight, as someone described it to me, as a knife fight, with Howard Lutnick being the one really to draw the knife first? Does this mean that potentially it's going to sour the potential for Scott Bessent? Are they almost attached at the hip now in front of this fight? And the fact of the matter is, it seems to have annoyed President-elect Trump, the fact that this has spilled out into the Twitter sphere, that they are now looking for other individuals like Apollo's Mark Rowan, like Kevin Warsh, like Senator Hagerty, who is back in the mix, and he's joining us tomorrow on Bloomberg Surveillance. We could talk to him about that. These are some of the other names that are now being discussed because it's become such a fight. But the whole thing is bizarre because the president-elect ran his entire campaign on the economy. So you would think this would be the team that he would have ready to go when he starts announcing his transition.
I will say Senator Hagerty was on Balance of Power last week, and he told them there's a pretty thin majority in the Senate, so he might want to stay there.
Yeah,
you know?
that's fair.
But he comes from Tennessee. Yeah. So it's not like the Tennessee governor is going to pick a Democrat to go fill that seat.
That's true.
Fair play.
It is really interesting, like Sonali mentioned, the dark horse of Mark Rowan. You also have Kevin Warsh, who we know that President Trump likes. He was in consideration to be Fed chair over the first go-around. But talk to us a little bit about what support Bessent still has out there. Of course, I know you spoke to Kyle Bass just a little bit earlier.
So Kyle Bass is one of the reasons why this kind of Twitter feud happened, with Elon Musk taking Howard Lutnick's opinion of where things should go. And when Kyle Bass came out and said it should be Scott Bessent, Elon Musk quote tweeted that and said, actually, you're wrong. He's business as usual. Here's what Kyle Bass had to say to us last hour on why he's not just business as usual, but he's an important pick for the Treasury.
Global central bankers around the world have respect for Bessent and his views. Scott looks at the world, with a 4D chess overlay, meaning he understands geopolitics, he understands people, he understands exactly what investment flows and economic flows matter and don't matter.
What a veteran investor like Kyle Bass is saying basically is you need someone that understands financial markets, and not just financial markets in the United States, but global financial markets. We also heard that as well this morning from the Wall Street Journal editorial, which I'm sure President-elect Donald Trump would be looking at, which basically said Elon Musk should not be putting his finger in this fight. I'm
wondering about that. I mean, I've heard reports that Trump is fuming, is the word used, I believe, with Howard Lutnick, attempting to put himself ahead of everyone else as part of his job running the transition. I've also heard he's annoyed with Elon Musk, who seems to be with him all the time, and apparently not just, staying at Mar-a-Lago, but also flying to New York to watch a UFC fight with the president. And by the way, the president flies to Madison Square Garden to watch a UFC fight?
Well, he was with Dana White, who's one of his closest friends and allies. Dana White left vacation to notoriously go speak for him at the RNC. So I imagine for President-elect Trump, it was a big deal to show up for that individual. But to your point on Elon Musk, they're almost attached at the hip at this point. And he is a self-described first buddy. And I think that's unnerving a lot of individuals around the transition, because Elon Musk is, deciding that he should have a say on almost everything. When it comes to Howard Lutnick, and we talked about this last week, this is the producer. This is the man who should be vetting every candidate for these jobs, and at the last minute, put his name into the ring to be the star, to rise up and potentially become the Treasury pick. And that is why it has caused a tremendous amount of tension. And potentially it is the reason why, and I'm just speculating here, it is the reason why Treasury now might be one of the last positions we know about. We got state, we got AG, we got defense, and we're still waiting on Treasury, which we know is near and dear to President-elect Donald Trump's heart.
And also not just about economic policy, but sanctions policy and a lot of pretty critical things. That will require a lot of skills to run that office. Anne-Marie Horder, we are so thankful to have you today. Of course, amazing reporting over the weekend. That is Bloomberg's chief political correspondent and co-host of Bloomberg Surveillance. Now, coming up a little later, we're going to talk to Wall Street lawyer Richard Farley, who joins us in the next hour to weigh in on the incoming Trump administration. Richard is in the running for SEC chair, according to Bloomberg reports. We'll ask him all about the future of regulation next. This is Bloomberg.
Welcome back to Bloomberg Open Interest. We're taking a look at futures right now. You can see a little bit of a rally. The S&P 500 up 0.1% after a big wipeout last week, down 2% on that index. Even more if you take a look at big tech. Of course, the Nasdaq 100 falling about 3.5% last week. Investors really questioning what the Fed is going to do at the same time as you have, of course, some of those Trump trades losing momentum, but a little bit of life in this market right now. The Nasdaq 100 up about 0.4%, and that's the same story if you take a look at the small caps. That's been your winner over the past month or so. The Russell 2000 up about 0.4%. Now, coming up, we're less than 4 minutes away from that opening bell. We'll discuss everything that's going on with Michelle Weaver of Morgan Stanley. This is Bloomberg.
We are moments away from the start of trading. The first day this week. It is a Monday. Happy Monday. This is Bloomberg Open Interest. I'm Matt Miller. You can see futures are up just barely on the S&P 500 right now. A little bit better on the Nasdaq as Tesla rallies after a Bloomberg scoop that the Trump administration is going to help approve self-driving cars across the country. There you hear the opening bell. It is, I believe, Axalta Coatings ringing the bell for their 10-year anniversary of the New York Stock Exchange. Down at the Nasdaq, you've got Fortinet, so they do cybersecurity. I thought it was interesting. Over the last 10 years, Axalta Coatings is up 84%, missing by about half the benchmark. Over the last 10 years, Fortinet is up 1,648%. So that would have been a good investment. In terms of investments this morning on the index level, Katie, what are you seeing?
I'm not seeing too much, but I am seeing green, Matt, and that is good news after the week we had last week. The S&P 500, it's green, but it's pretty much unchanged. An optimist would say we're still a little bit higher right now. We are truly higher when it comes to the Nasdaq 100, currently higher by about 0.2% on your big tech benchmark. We'll see how durable that is, of course. Same thing, too, if you take a look at the small caps, a little bit higher right now as the S&P 500 decides what to do, but the small caps currently higher, 0.2%. There's more action under the surface right now. I want to take a look at shares of Liberty and Oklo soaring after Donald Trump nominated Chris White as Energy Secretary. Wright is, of course, the CEO of Liberty. He serves on Oklo's board right now. You can see that the market is deciding that is good news, sending shares of both stocks higher right now, Sonali.
And more Trump transition news over here, too, Katie, sending a stock higher. And, of course, that's once again Tesla, up about 4.7%. The transition team told advisors that they're planning on easing the rules for self-driving cars, which would then be a boost to Tesla's own efforts, Matt.
And NVIDIA shares are falling this morning after a report that the server racks for the company's new Blackwell chips are too hot. They're facing a design problem. NVIDIA posts its quarterly financials on Wednesday after the market closes, and we're very much looking forward to that. For a deeper dive, let's bring in Bloomberg's Abigail Doolittle. Abby, what do you got?
Well, here is the decline on the day, down 1.5%, but to your point, down 2 days in a row. Lots of volatility here for NVIDIA, but nonetheless around 140, so near the highs of the year. Big rally for this stock, so lots of pressure on the quarterly report later this this week. Now, something to point out, the growth will be phenomenal. They're expected to report 74 cents in adjusted earnings on $33.2 billion, but it is declining growth. This represents roughly 84.2% growth on a year-over-year basis. And that is down from 100% growth and down from nearly 600% growth. So moving in the wrong direction. As for the gains of NVIDIA, it's 25% of this year's rally for the S&P 500. Last time I looked, around 25% growth or 25% gains on the year or so. So lots of dependence on NVIDIA. This quarter has to come in well. We may now have that declining growth board. I'm not quite sure. Let's take a look at what we have next, that declining growth. Again, something to think about. No, we actually have, this is a really interesting
chart,
look.
though.
This is a great chart here. The S&P 500, the SOX, 73% of the members are more than 20% from the highs. That SOX really caught in this bearish diamond top pattern, suggesting that investors are slowly but surely taking profits there. And then you can see healthcare, energy, technology, material staples. Also, you have a good portion of those members from 20% or more from the recent high. But that SOX, that's really something to take a look at, Katie. And that NVIDIA report on Wednesday, it will be, as you know, all important.
All important, and a real choose your own adventure with the charts. Abigail Doolittle, thank you for rolling with it. And let's broaden out this conversation right now with Michelle Weaver. She is U.S. Thematic Equity Strategist over at Morgan Stanley. Great to have you in person with us.
Thank you for having me.
I want to talk about the thematic portion of your title, because when you think about the themes and the narratives that are going to drive this market from here, what is top of mind for you?
I think one important thing, so we're obviously all thinking about what's going on post-election. Reshoring is a really exciting theme that's coming back to the forefront. And I think it's really moved in fits and starts. So under the initial Trump administration, that really lit the initial fire for industrial production to start coming back to the U.S. Then you had COVID come in and you saw supply chains completely snarl and shut down. And now we think that the next wave, the second Trump administration, will drive that even further. Our industrials analyst actually estimates that this is a $10 trillion opportunity. So this could be huge for the U.S.
Hang on, what is a $10 trillion opportunity?
The reshoring, U.S.
Reshoring.
industrials coming back.
That's a massive number.
That is a massive number, absolutely. Yeah. That's why we're so excited about it. And this isn't just a story, though, of we're closing factories in Asia and then moving them back to the United States. Manufacturing is a growth market. The pie is getting bigger. So not only would you see some closing of overseas manufacturing coming back, but also just locating your new incremental factories in the United States.
I was going to bring up $1 trillion.
That's nothing.
Because that's what Bloomberg estimates companies are going to spend on, I think, data centers, electric infrastructure, and telecoms networks for AI. In fact, Moody's says $2 trillion over the next 5 years. And I was thinking, we haven't seen that much investment outside of a war since forever, right? That's only war. Needs $2 trillion in a 5-year time period. Isn't that like the biggest theme that there is?
So this is a multi-decade opportunity. This isn't 1 or 2 years.
Your reshoring
This is the
theme.
reshoring
AI,
theme.
Moody's says $2 trillion in 5 years. I mean, that's a relatively short period of time to spend $2 trillion.
That is absolutely a huge number, but we're seeing it's not just tech companies. It's everyone is trying to get into this AI theme, and we think that that's going to continue to broaden out. Companies are going to continue to adopt. We've done survey work that shows that it's really next year where you're going to start seeing AI go into production versus into more of a testing phase. Largely, we've seen, you give it to your programmers, you're trying to see what can go on with the R&D phase, but we haven't seen many results yet, and we think that that's going to start hitting next year.
I want to understand how these themes play into the broader market view, because you have your team raising the S&P target for next year to 6,500, and if that's true, that's roughly a 10% or more, 11% upside to where you saw more recently. So what
Same as Mike Wilson's target.
Right, they're on the same team.
Yeah.
And so the question I have is, how can you be so sure that the negatives that will hit certain sectors won't offset the positives that you might see?
So we have quite a large range. I think it's not just, okay, great, the market's going up 11% next year. We saw so many rotations under the surface this year. Beginning of the year, okay, are we going to have no landing? Is inflation going to continue to be problematic? Then we went to, okay, are we going to have a soft landing? Then a hard landing over the summer. Now we're back into the soft landing camp. So you have to give room to maneuver under the surface. But we think overall the direction of travel is positive.
Let's talk about where the consumer wraps into all of that, because you've gotten retail sales strong, consumer confidence surveys are strong. We have an interesting round of retail earnings coming up this week. Walmart, Lowe's, TJX, the list goes on. And even with those strong readings that you're seeing at the survey and data collection level, you're not necessarily seeing it broad brushstrokes in all of those retailers.
So I think it's really a question of the aggregate versus the average. So if we look at how the consumer is doing at the aggregate level, the economic data is still coming in very strong. But we do a lot of proprietary survey work asking people about their attitudes, their spending plans, and we found that the average consumer is still feeling the impacts of multiple years of inflation. They're still being a little bit more selective. They're still seeking value. But we are seeing some signs of a more positive picture for consumer companies. We recently ran a survey looking at plans for holiday shopping, and we had more positive reading this year versus the past 2 years. So we could see some spending start to pick up more broadly.
Are you concerned about, inflation due to tariffs, tax changes, immigration, leading to, the Fed not only not cutting rates, but as some have warned, actually having to raise rates?
So I don't think a raise is necessarily on the table here. It could impact the path of what's going on with rate cuts. It's too soon to tell. Is it going to be a universal tariff? Is it going to be more targeted on a specific region? Our economists recently took one rate cut off the table, so now they're at another 100 basis points of total cuts through May. They were at 125, so we're seeing a little bit of pullback there. But it's really still too soon to say.
How would that impact things outside of the S&P? We talk about the Russell 2000 so much, and if you don't see those rate cuts, if you see those rate hikes, as Matt was suggesting, does that mean the Russell 2000 case gets wiped away?
So for the Russell 2000, we're really neutral on large cap versus small caps. The time you want to buy small caps is when you're in a recession. That's the time that lower quality names, you get that washout, and then they're able to reaccelerate higher. They're really an early cycle play. So we think it is still too early to be buying small caps. Neutral position seems to work there best.
All right, Michelle, good place to leave it. Really great to catch up with you. Kick off this trading week. That is Michelle Weaver of Morgan Stanley. Now, coming up, the Trump team is looking to prioritize federal framework for self-driving vehicles. And surprise, that's good news for Elon Musk. That conversation up next. This is Bloomberg. Welcome back to Bloomberg Open Interest. A quick check on stocks. Of course, we are a couple minutes into the trading day. We still have green on the screen, at least for right now. We'll see what happens between now and 4 p.m. But your S&P 500 higher by about 0.1%. It's time now for our top calls. Some of the analyst action in focus this morning. And first up, HSBC upgrading Moderna to a buy from a hold with a $58 price target. The analyst says that the market isn't giving enough credit to the firm's pipeline. Next up, we have CVS upgraded to overweight over at Wells Fargo, with the analyst noticing that the Medicare Advantage risk-reward looks better under Republicans. And finally, you have Baird upgrading Roku to outperform with a $90 price target. The analyst citing meaningful changes in the business and the attractive long-term opportunity. Matt, that is a quote.
That is a fantastic quote. I'll remember that one. I want to take a look at some of the auto stocks that we're following today, and I guess tech stocks. What's Tesla? What's Mobileye? Really a tech stock there. Companies linked to self-driving cars are on cruise control this morning. I would say they're accelerating. Members of the Trump team have told advisors they plan to prioritize a federal framework for fully autonomous vehicles. Here with more is Bloomberg's David Welch. David, it couldn't have been completely unexpected, right? It's a huge part of Elon Musk's pitch, and he has been essentially the co-president-elect. So what do we know?
Look, Elon himself said on the third quarter earnings call that he favors some sort of federal framework or federal set of rules for autonomous vehicles. We don't really have one right now, and we don't know exactly what the Trump team wants to put in place, and honestly, they may not know at this point. We just know that it's a priority as they look to name a new Department of Transportation secretary. And that's in the works right now, expected maybe this week or next that they'll actually name that person. But one of their priorities, among others, the Transportation Department of Transportation job is actually pretty big. But one of them is to get some sort of set of federal rules on autonomous vehicles. Right now, if you want to run vehicles without pedals, without a steering wheel, you have to get a special exemption from the National Highway Transportation Safety Administration, NHTSA, which is part of the DOT. And they will grant you the right to have 2,500 of those vehicles max for 1 year. There have been pushes in the past to get up to 100,000 of them per year that have gotten nowhere. There have also been a lot of attempts at legislation that would create a federal framework over AVs. And they've all gotten bogged down in either the House or the Senate, either because organized labor opposed or the trial lawyers opposed it, and it's just never really come through. You would probably, honestly, to really scale up the way Elon Musk wants to, you would probably need an act of Congress. But NHTSA does have some powers to expand the rules to get more vehicles on the road, and that would increase testing and potentially be enough for somebody to start a business in certain cities with robotaxis. So I'm not sure exactly what they would do, but the fact that they're willing to do it could kind of break a logjam that we've had over federal rules on autonomous vehicles going back 2 administrations.
To the point you were making on Congress alone, David, what do you make of these market reactions? Do you think that they're overblown, given all the hurdles that you just lined out?
Yeah, look, there's a lot that needs to happen in order to really enable the kind of robotaxi fleet that Elon Musk is talking about, including letting people who own vehicles lease them out. He's talked about that in the past, just selling a robotaxi. General Motors has tried to get an exemption for their Origin shuttle for 2 years, and they finally gave up on it. And so does regulation at the federal level help them do that? Quite possibly, but yeah, until we know what it is, until we know what's being proposed, all it is it's a priority. And look, the market is betting that with Republican control of the House and the Senate, that if they want to do something on a bigger basis through Congress, they can get it done. And they probably could, given the majorities they have. The wild card here is Donald Trump himself. He said in Michigan that he didn't really like robotaxis and he wanted to get them off the road. Now, Elon Musk spends a lot of time at Mar-a-Lago, and maybe he's convinced him otherwise. But getting some rules on here is a start. It's a big start.
Well, David, I'm glad you brought that up, that Trump has said he doesn't like robo-taxis, because he's also said that he doesn't really like the EV industry either. So obviously the market is taking what we learned today as good news, but weigh that out with the fact that Trump is planning to nix the tax credit for EVs. How does it shake out overall for Tesla?
I think Tesla has, Elon has sort of indicated that it would hurt the others more than him, so he's not so worried about it. And I think it does give him an advantage because he can make money on these vehicles and he can sell them in big numbers without a $7,500 tax credit. And it hurts the companies that are still trying to build scale. And it increases their losses in most cases, or General Motors is getting close to making a profit on these. They're supposed to be making variable profit this quarter, and that includes some of the tax credits that they get on the manufacturing side. That's a different credit, and it does help them sell more. So that could set their EV program back as well. And if you do that and you still need to meet clean air requirements in California, say, and the conventional auto companies are selling fewer EVs, which would help them meet that, then they have to go crawling back to Elon and buy EV credits from him to meet regulations in California and in other places. So you could see some kind of chess scenarios here where it benefits Elon Musk more to get rid of those credits or to water them down than not. It's not as easy as a snap of a finger to do that. Congress needs to vote on some of these things. But again, Trump's got a majority and he may be able to do it.
All right, David, thanks very much. Bloomberg's David Welch there reporting on the potential for an easing of self-driving car regulation. Coming up, bankers and the titans of private capital want to team up to fund a $1 trillion AI spend. We'll take a look next in today's Wall Street Beat. This is Bloomberg.
This is Bloomberg Open Interest. We're taking a look at the stock market, now turning lower on the S&P 500, down in the red, just a hair, but still counts there. You take a look at the Nasdaq 100, trying to hold gains for that big tech index, higher by about just 0.1%. Same story, too, if you take a look at the small cap Sonali, currently higher by about 0.1% on the Russell 2000.
And Katie, we're going to shift gears for the Wall Street beat now. We're going to talk about the $1 trillion AI hysteria that bankers are taking a look at. They are looking for a piece of that financial pie. That's the subject of today's Big Take. Neil Callanan co-wrote the story, joins us now. We're looking at picks and shovels, and one kind of centerpiece of this story is just how much Wall Street is banding together to get this done. Is the money there at the end of the day for this grand ambition?
Absolutely. At the moment, everybody wants a slice of this pie. It's the new gold rush. You know, bankers have had a tough couple of years. M&A hasn't recovered. Leveraged loans are the leveraged loan market has been suffering, and so everybody wants in on this AI-driven boom. There's some skepticism as to whether the technology will actually be successful, but the amount of checks that are being written and the size of those checks means all the Wall Street banks see a great opportunity here, as do the private capital providers as well.
Yeah, normally they would be competing, right? But I thought the interesting piece from this story is that regardless of whether or not the technology is successful, Bloomberg estimates we're going to need to spend $1 trillion just to get the data centers up and running and, you know, connected to networks. Moody's says $2 trillion, and the banks just don't have enough firepower. They need to team up with private equity, private credit in order to finance this.
Yeah, these are huge numbers, and the message from the banks is let's work together because we can both make a lot of money if we do this going forward. And that money is there. You know, private equity has been raising a lot of dry powder for this. To give people an idea of what we're talking about, the power needed for AI just in the US is expected to be the equivalent of 3 New York cities. So that's a huge increase in the amount of power that's needed. And so a lot of people are more interested in investing in that power supply that will go to the data centers and AI than maybe just the data centers themselves. So that's one way of getting protection. The other way they're getting protection is these things have 25-year leases from companies like Meta and Amazon, and that's very, very, very attractive to both lenders and investors.
How concerned, Neil, are people worried about tourists? This idea that a lot of people are flying into an industry that they know so little about.
That's an issue, and a wider issue in finance when you have so much capital running around at the moment, and there will be, you know, concern that people aren't doing enough underwriting on these projects. There's talk of zombie projects where people are building data centers and then can't get power grid connections. In Ireland, there's a huge concern that without these power connections, data centers and their operators will leave the country, and that could lead to have big consequences in terms of the technology industry within the country. So there are going to be these tourist investors, but you know, the opportunity seems too attractive for them to walk away from.
All right, Neil, it's a great story. It's today's Big Take. That is Bloomberg's Neil Callanan, of course. You can find that story on Bloomberg.com or on the terminal. Meanwhile, you turn back to these markets right now, guys. You see the S&P 500 just a hair lower. Your biggest points loser right now in the index is NVIDIA. We know we've been following that Blackwell production story. We know that they report on Wednesday. You think about where we stand right now, the month that we've had in this market, that's going to be a big report in terms of sentiment.
Yeah, huge. I mean, you can't understate the importance of NVIDIA, not just in the S&P, but also in the MSCI World Index, right? It's bigger than some very large countries.
I've heard that.
Yeah, so it is key, but I think the reason it's down today is because of the heat in the servers, and that's an issue that they have to work out because there's no other supplier of these chips right now.
Frankly, I know everyone wants to talk about NVIDIA. I'm equally excited about Walmart tomorrow. It's a big week, actually, in the markets this week.
Yeah, a huge employer and a great story for the U.S. economy. Coming up next hour, we're going to talk with Richard Farley on the M&A environment and Sara Silverstein of the Arena Group. This is Bloomberg. We are 30 minutes into this Monday in the cash session. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, Trump's search for a Treasury secretary devolved into disarray over the weekend, with contenders tussling for support.
Meet another contender for Trump's team, Wall Street lawyer Richard Farley, who's reportedly in the running for SEC chair, joins us here in the studio.
And of course, all of that comes ahead of a big earnings week this week. We have NVIDIA, we have other retailers on deck as well, including Walmart. So plenty to look forward to. We take a look at where we stand in markets right now. Not too pretty. It's a quiet trade so far, but the S&P 500, it did flip from slight gains to slight losses. Its biggest loser right now, of course, NVIDIA, tussling right now with Tesla, which is up quite a bit. Then you take a look at the NASDAQ 100, where that same battle is happening right now. You can see the NASDAQ 100 managing to hold on to its early gains, up about 0.2%, and all quiet in the bond market at very high levels, though. The 10-year Treasury yield higher by about 2 basis points, camped out just below 4.5%, Matt.
All right, Donald Trump's election victory has bankers more optimistic about the M&A environment, with JP Morgan CEO Jamie Dimon saying they're looking harder at acquisitions in anticipation of less regulation. In fact, he said bankers are dancing in the streets after Trump's win. Joining us now is Richard Farley, partner and chair of the leveraged finance group at Kramer, Levin, Naftalis, and Frankel. Richard advises and represents some of the world's leading commercial and investment banks and is also reportedly being considered to replace Gary Gensler as the chair of the SEC. And Richard, seems almost rude for me to ask, but I have to as a journalist. What do you know about this potential position? Will you run the SEC?
You'll be the first to know. I can't really comment on the process except to say that I and many other qualified candidates have been floated, and we'll see. And I think when your country asks you to serve, I think you've got to make yourself available if you think you can do the job. So,
all right, excellent. Well, let me ask you then another question that becomes even more interesting. What's your view on the regulatory setup as Gary Gensler has left it for the next SEC chair, and how do you think it could change?
Well, look, I think there were a number of initiatives that took place during the Gensler years. The SPAC rules, the environmental disclosure, obviously everyone's struggling with the proper regulation, if any, of Bitcoin. I personally think some of that's going too far. And I think that a hard look will be taken at those things which protect investors but don't overly restrict the issuers of securities and the trading of securities. But it's an iterative process, and you've got 5 commissioners on the SEC who have to agree, or at least 3.
Yeah.
Well, you mentioned Gary Gensler, and all the crypto people watching, of course, just turned up their volume. So I have to talk to you directly about how you feel about crypto. There have been some big regulatory wins. We finally saw some spot Bitcoin ETFs launch over the past year. But how do you think about the regulatory environment as it pertains specifically to cryptocurrencies?
Look, I do not have hard and fast opinions on that at the moment. I think you've got to take a look at all the considerations, including the protection of investors, and come up with the right balance. But I do not have any hard and fast thoughts on that.
If we had to broaden the aperture here and look even beyond the SEC, certainly there was an aggressive posturing by the SEC under the Gensler era. But what about the other agencies? You think about the FTC, for example. There's this kind of clamoring on Wall Street for a looser antitrust environment. But do you think that the deal makers will get it?
Yes. I think that Lina Khan will not be there very long after January 20th. I think that my own personal opinion is the enforcement has gone too far, and the challenging of transactions has gone too far. But again, a lot of these things are driven by boots on the ground and what's happening in each transaction that's reviewed. But I do think that's gone too far.
But you also don't think that Lina Khan and her attempts to stop some of the big deals is really behind, or the only thing behind, the slowdown in M&A, right? Because
of course not. No.
There have been a lot of issues.
I think interest rates have had more of an impact, right?
Exactly. You had huge inflation. You had the march up in rates from nothing to 5.5. Is that going to turn around completely? I mean, we've already got doubts in this market that the Fed's going to be able to cut as much as it wants.
Well, look, I think that with the Trump administration policy on energy, I think that energy costs are going to come way down. And I think that is going to have a de-inflationary impact, which will make it easier for the Fed to reduce rates. There are other things on the other side of the equation you have to watch. I mean, what impact will tariffs have? What impact will deficit spending have? But I think on balance, I think rates will come down.
But how much? Because even if you believe you'll get that rate cut...
But any idea about that, I would resign my membership in the bar and become an interest rate trader.
But either put yourself in the ring for Treasury.
Yeah, right. Yeah, with everybody else. But either way, you have less than what was expected.
Yeah.
And what I'm wondering is how much that will really unclog the system here, because private equity in particular...
Right.
has been gummed up. And if rates stay this high, then how are they going to be able to borrow enough to get the deal
I don't think
done?
anyone thinks that the rates are going to stay this high for any extended period of time. So I think ultimately rates are going to be reduced in a significant way. Is it going back to zero? No. And let's hope not, because that's an indication that there's something fundamentally wrong. But again, I wouldn't be shocked to see things in the 3-ish range over the course of the next 18 months.
Interesting. So let's put it all together. Of course, interest rates coming down, maybe to that 3% range, Lena Khan out, a better regulatory environment. When it comes to what pickup that will translate to for deals, are we talking bigger deals? Are we talking more volume? Or are we talking both?
I think both. I think that the reduction in interest rates will increase volume. And I think that the reduction in the overly aggressive antitrust enforcement will make it available to do larger deals.
I want to get your view on what the economy will look like as these policies are put into place, because you've made the point to me before that it's really the business fundamentals that drive these M&A transactions. So if we have, tariffs and reduced immigration that cause some inflation, on the other hand, a reduction in regulation and tax cuts that drive growth, how does the balance look to you?
Well, we have another factor we haven't discussed, which is the rolling out of AI. We've seen the massive investment, and that continues, but we really haven't seen that impact the efficiencies of most businesses. And I think that's a very large and looming reduction on the cost side. And an increase in jobs, right? It isn't just a net loss of jobs. That's going to create other things for people to do to create growth and efficiencies. So I think that's looming, and that could be incredibly transformational.
But your view on whether or not growth is strong enough to overcome the climbing deficit that we're all afraid of?
No. I mean, we have to tackle the deficit. And growth is obviously a large part of that, but is also the increase in revenues and reduction in expenses. So I think it's all three.
The way we think about the debt load moving forward, in part, will be dictated by who's at the head of the Treasury Department. There's been so much scuffling about this, and every single candidate has such a different flavor. You have Mark Rowan, who is in tune with the new financial system. You have a pro-crypto candidate in Howard Lutnick. And then you have, of course, Scott Bessent, who knows the intricacies of the macro markets globally.
Right.
Who would you choose?
I think they're all fabulous candidates. And I think they all have incredible strengths. And I think that we have a very good menu for the president. So I think this is a happy place to be, rather than looking at candidates who may not be able to perform the job at a high level. I think they're all great.
Yeah, that menu seems to be expanding, but all good candidates in your words, so maybe it's a happy problem there. I want to talk, though, a little bit, too, about private credit. The last time you were on, we had that conversation.
Right.
And if we're talking about interest rates coming down to that 3% level, do we see some of that activity move out of the private credit system and maybe more into public markets?
I don't think that the two products, if you want to view them differently, the syndicated loan and the private loan, are now being arbitraged as a result of an interest rate environment. There are other factors that come into place: ease of execution, not requiring a rating, not requiring a significant sales effort, having the process for the debt done when you sign the acquisition agreement. There are many things that private credit offer, not just the interest rates are down, the syndicated market's open, it's all going to shift over there. I think that volatility between the two asset classes is going to reduce significantly going forward.
We have a great story, the big take story, on Morgan Stanley reportedly held a dinner and invited a bunch of private credit players and said, hey, this pie is big enough for all of us. Let's not hurt each other in competition, but help each other in collaboration. And that, driven by the AI spending, leads me to believe that Wall Street is going to be a good place to work the next 4 years. And I just want to get your take on that.
No, I think it is. I mean, it always has been, except for some very limited periods of time over history. It's been an incredible wealth engine, particularly for those who work there. But look, I think that the origination that the large banks have is an enormous asset. And if there are deals they can't do or don't want to do, and they have arrangements with private credit providers who can, which we saw with the Apollo Citi transaction, those are going to continue because you have two very powerful capabilities, one being the origination, the other being the vast pool of private credit. So I think those sorts of arrangements are going to continue, as we discussed a few weeks ago. And also getting back to the point of conditions in the industry are going to drive M&A. I think there's going to be significant consolidation in the private credit space. So I'd watch out for that.
All right, Richard, we have to leave it there, but keep in touch.
I will.
Come back soon.
We'll see you interviewing Ken Griffin in a few days. We're looking forward to that at the Economic Club.
About the SEC for sure.
I would imagine so. Richard, great to have you back.
Thank you.
That is Richard Farley of Kramer, Levin, Naftalis, and Frankel. Let's switch over to hedge funds and what exactly they're doing right now, because fund managers net sold U.S. single stocks for the first time in 7 weeks. Bloomberg's Natalia Kunijevic has all the details.
Hi, Katie. Yes, that move was largely driven by short selling. We see that hedge funds also sold macro products. These are ETFs and indexes. However, we did see some buying, specifically across financials, healthcare, real estate, and consumer discretionary stocks. It's interesting to look at healthcare stocks because year to date, this is the worst performing sector within the S&P 500. But hedge funds have been buying this sector in 7 of the past 8 weeks. So it looks like they are buying the dip. So when it comes to net sold sectors, we see that hedge funds sold consumer communication services, materials, as well as information technology. And it looks like hedge funds are getting bearish on big tech stocks again.
Well, how bearish, Natalia? What does options positioning look like? And what is the sentiment ahead of NVIDIA on Wednesday?
Right. So options traders are getting bearish as well. So we saw option traders selling some of the most bullish positions on big tech, specifically NVIDIA and specifically around earnings. So this chart also shows that shows how much basically traders are willing to pay for a potential volatility to the upside versus downside. It's a spread between options that expire 10% above the strike price versus options that expire 10% below the strike price. We clearly see that there is not too much appetite to pay for a potential move to the upside. And some traders are now getting ready for for negative stock price, especially around earnings.
Yeah, on Wednesday, we'll get those earnings. Natalia, thanks so much for joining us. Natalia Kunijevic, they're talking to us about options indications. Coming up, we're live from Rio in Brazil as world leaders gather for the G20 summit. This is Bloomberg. They're probably not on the beach, but...
No, David is.
Yeah?
Yeah.
It's at least in the background.
Let's get now to high interest and look at what's making headlines around the world. Goldman Sachs is preparing plans to spin out its digital assets platform. They involve creating a new company that will allow large financial firms to create, trade, and settle financial instruments using the blockchain. Goldman is looking to execute the spin out within the next 12 to 18 months. And New York City transit officials are meeting now and set to vote on a revised toll program that would charge most motorists $9 to drive into sections of Manhattan. The toll is set to start in January. The fee is set to rise by $15 by 2031. New York Governor Kathy Hochul wants to push through the congestion prices policy before President-elect Trump, who opposes the fee, takes office. It's laughably low compared to what it had been suggested and what London pays now. Ukraine's allies are increasingly leaning on President Zelensky to consider new ways to negotiate with President Putin and end the war. German Chancellor Olaf Scholz called Putin on Friday. French President Macron said he would speak to Putin when the time was right. President-elect Donald Trump has pledged a quick end to the war when he returns to the White House he might be in regular communication with Vladimir Putin. Who knows? Let's stay on geopolitics and turn, though, to Brazil. World leaders are gathering for what will be President Joe Biden's final G20 summit in Rio de Janeiro. And we want to go straight to Bloomberg's David Gura, who joins us from the ground in Brazil. David, I guess President Xi's attendance and the meetings he's had, the statements he's made are the most newsworthy right now. He's very adamant that the U.S. continue to acknowledge his 4 red lines.
Yeah, he brought them up this weekend in Peru, where he and Joe Biden were before they came here. That was where the APEC summit took place. They had their first meeting since April, their first conversation since April, I should say. It was a phone call they had back then. And he said, while it's in the world's best interest for these 2 superpowers to have a cordial relationship with one another, there are things that it doesn't want lines the U.S. he doesn't want the U.S. to cross. That comes to sort of human rights and democracy. Comes to economic considerations as well. So I see him as kind of positioning himself for this huge change that's about to happen in January, which I think is what's lingering over everyone's conversations here in Rio. They were lingering over those conversations in Lima, Peru as well. And that is Donald Trump is coming back to the White House. And while Joe Biden is here having conversations with people that he knows very well and has talked to for a long time, espoused the benefits of multilateralism too over these many years, things are going to change. And I will say most of the world leaders here who were in power back in 2016, 2017 have been through this before. And that's the most marked change, I think, between that summit back in 2016 and this one. There's very little uncertainty here about what this is going to mean for the global order. Yes, there's kind of a change of flavor, perhaps, how high those tariffs might be, how draconian they might be, but they know how Donald Trump governs. So we're seeing this kind of movement toward China, which I think you're getting at, Matt, and that is acknowledging the fact that China's made a lot of inroads here in South America, other places in the world, and really the bulk of those meetings, those one-on-one meetings are happening with the Chinese premier and those other world leaders.
But it's interesting because at the same time, you had UK's Keir Starmer having sort of a friction-filled meeting, David, didn't you?
So he got here yesterday. This was his first bilateral meeting. It took place this morning. And after that meeting, he spoke to reporters with President Xi next to him and began talking about human rights, began talking about Taiwan. And then all of a sudden, all of the press was kind of ushered out by the Chinese minders who were there in the room. So these are obviously very sensitive subjects and kind of illustrates the fact that Keir Starmer is rather new to the world stage in this way. He's having to navigate the kind of peculiarities of having these high-level relationships with other world leaders. And I should say, him coming here and having that meeting is significant as well. There hasn't been a UK prime minister who's had a one-on-one meeting with the Chinese president since 2018 when Theresa May was in office. So this was a moment when he was trying to reset that relationship. And as you say, it got off to a rather tricky start.
And of course, Joe Biden appearing there. I have to imagine, though, that the elephant in the room is Donald Trump. What are the conversations around the incoming U.S. president sounding like?
Well, as I said, there's no uncertainty about sort of what it might mean in broad terms. But I think that you see these countries sort of working with one another to kind of telegraph, figure out what their tack is going to be going forward here, who's going to work with whom. And China is obviously a huge principal in those conversations when it comes to trade relationships and sort of how the sort of world landscape is rearranged as a result of Donald Trump coming to power. I think that the issue of Ukraine is not one that's formally on the agenda here. That these countries are kind of hashing out what's going to be on that communique, that statement, and it's something that's likely to be mentioned, at least in broad strokes. But there's been so much movement on that issue over the weekend that it's kind of coloring a lot of the conversations that folks are having, both with and without Joe Biden. We had Olaf Scholz, the Chancellor of Germany, reaching out to Vladimir Putin of Russia over the weekend, having a phone call, which is extraordinary in and of itself. He tipped off Vladimir Zelensky, the president of Ukraine, that he was going to have that conversation and updated him afterward. So folks here are eager to hear from the chancellor himself about what was discussed on that call. And going back to something Matt mentioned just a few moments ago, there is this movement among allies toward what's the resolution of this war in Ukraine going to be? How do you get to a negotiated settlement? What might that look like? And all the while, you have Joe Biden, the U.S. president, now allowing the use of U.S. weapons against Russia on Russian soil. So it's part of this plan. It's part of what Joe Biden is doing here in the final days of his presidency to make sure that he's giving Ukraine the resources it needs to keep fighting that war. As all the while, he's kind of recognizing the fact that he's going to be less and less a part of that conversation.
David, thanks very much. David Gura there reporting live from the G20 summit in Rio, hopefully wearing really strong sunscreen. Still ahead, Netflix scores big this Christmas. Beyonce is set to join the company's NFL debut. Details on that next. This is Bloomberg.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, Manulife CEO Roy Gori will retire in May. He'll be succeeded by Phil Witherington. He is currently head of the company's Asia business. Gori has been CEO since 2017. Next up, Beyonce will headline the NFL's halftime show when it streams on Netflix on Christmas Day. That's a huge win for Netflix as it bets big on live sports and mega events. And speaking of, that widely anticipated fight between Jake Paul and Mike Tyson may have failed to live up to the hype, but it didn't disappoint from a rating standpoint. Netflix reported an audience of 65 million viewers, rivaling some of the world's most watched sporting events. Now, the 27-year-old Paul easily beat the 58-year-old Tyson after 8 rounds. Paul took home $40 million. Tyson got $20 million. Matt, I know you have feelings about this.
Well, I mean, first of all, my connection kept fizzing out, and so did the connections of a bunch of friends. So I don't feel like Netflix was really set up to handle the traffic, but I also don't feel like Mike Tyson was throwing the punches he could have. He seemed to be holding back, like he didn't really want to knock out Paul and let the match drag on.
Or maybe he's just 58 years old. I don't know. But both of them got paid mightily. So, I mean, Netflix won from rating standpoint, and of course, both of them getting big paydays. And it's an interesting proving ground for Netflix. They want to do more live sports, Matt, but they have some kinks to work out there.
Yeah, they better work on their technology if they want to do that again. Coming up, we're going to talk to Sara Silverstein. She's the CEO of the Arena Group. They turned their first profit in the last quarter. We'll find out how. This is Bloomberg. The company behind media brands like TheStreet.com, Men's Journal, Surfer Magazine as well, is changing its narrative. The Arena Group announcing its first ever profitable quarter in Q3. The turnaround charged by cutting quarterly operating expenses 51% year over year and growing the audience a phenomenal amount. Joining us now is Sara Silverstein. She's the CEO of the Arena Group. So coming to a profit for the first time, you've done that by reducing costs, but I know you haven't also shrunk the editorial team very much. So you're reducing costs, keeping your staff, and somehow growing the audience. How do you do it?
We're keeping our editorial costs. We're also keeping our tech costs. We've made some cuts in lower margin businesses, but we feel like we really need good content and to continue to grow our real audience to go into the next chapter and show that not only can we be profitable, but we can also grow.
And I want to get into the content story, but I do want to talk a little bit more about the cost cutting because 51% is quite a number. When you look over the next year, for example, do you think that you're pretty much at the end of your cost cutting cycle, or do you think that there's still more to come?
Yeah, we really try to do all of that up front, mostly because we really believe in transparency and our business leaders being a part of the decision making. So if that was always looming overhead, we were worried that they wouldn't get on board and help us make the right decisions. So we're really trying to open up our books a little bit to the team so that they can make the best decisions for long-term profitability as opposed to short-term results.
I am curious about the role of different franchises that you have within the Arena Group. You have different arenas, as you've called them, sports. What role does that play right now? How competitive is this space, and how much room for growth is there, given that you have people wanting to read more about sports as sports betting continues to take off?
Absolutely. So our Athlon Sports publication has grown really huge. Now they're in the top 10. I think they grew 300% over the last few months. So it's been really exciting for us. And we have more than one sports publication. We also have The Spun. And yeah, as people are more interested, you know, we follow the audience. We follow what their interests are.
I typically would go to a newsstand and pick up like Men's Journal or
Old School.
Men's Fitness, right? That's not how the kids are consuming media nowadays. I know a lot of companies aren't even putting out a paper magazine anymore. It's the same, I imagine, with the Arena Group. How much bigger is, you know, the online presence than the publishing presence?
The online presence is the whole thing. So our digital media is really where we make our money and where our sustainable business is. But we do still have magazines. Athlon does a lot of previews for each season instead of a regular weekly or monthly magazine. And same with Powder and Surfer. They have at least one issue that goes out a year, which is really nice for the brand. But that's not how we make our money.
That's really interesting. I mean, there is something to be said for buying a physical, heavy magazine with the glossy pages and the bright pictures. But
take it on the airplane, you put it on your coffee table.
Exactly, exactly. But yeah, everything's online now. I want to talk a little bit about the portfolio of companies that you work with, because obviously you have a big presence in sports, in lifestyle sort of categories as well. What does the due diligence look like on your end when you're evaluating what brands that you want to work with?
Well, right now we're growing our audience so much because we don't have a paywall for any of our journalism. The only thing that is behind a paywall is our street investment product. All of our content is brand safe. We're really trying to build out a real retail ecosystem and expand our commerce team and our first-party data and how all that connects. So for us, if it's part of the bigger plan, if it helps us grow our audience that we're reaching, our real organic audience, then it's for us.
How often are you thinking about inorganic opportunities? You've turned a profit. Can you put that money to work to acquire something to build any of your arenas?
Right now, we would be looking at partners, like publications that we could bring on, and also tools and services that we could bring on, but we're certainly not looking to buy traffic right now because our value is in how do we leverage the real audience that we have.
I like how you use the term arenas there.
I like
so
it.
I guess at the arena group, you say this is our sports arena, this is our lifestyle arena, this is our finance arena, which is what you ran before you took over the parent company, and it's what I think we're most interested in, right? So how did you drive so much growth at the street? We notice it as a competitor and as a source a lot of times. And what do you think about interest right now in the finance arena as we hit all-time highs on the S&P, super tight spreads on credit?
I mean, it's been great for the street. The street's original focus when it was under Jim Kramer was the subscription product. So I had a lot of room to grow, and that the street has such a smart team that it was really about how do we get this in front of the audience, and that was just a little bit about, it was mostly about changing what we were covering instead of trying to be the statement of record where we can't compete with a Bloomberg that has 2,500 journalists. I'm probably going to say the number wrong, but we have a small team that's trying to, story selection allows them to say, this is what's important for you today, and that made a huge difference for us.
Sarah, I think a lot of publishers are thinking about this right now. How are you thinking about the role of artificial intelligence as you grow your platforms?
So we are not looking at artificial intelligence to create content. I think that we can't win in that area. Google's going to beat us. Other people are going to beat us. But we are looking for artificial intelligence to help us in our technology and serving people better, and what's the next thing that they should read, or to serve our retail partners better.
All right, Sara, it's really great to have this conversation with you. Hope to see you again soon. That, of course, is Sara Silverstein of the Arena Group. Now let's get a check on these markets. Of course, it's an interesting day. It's an interesting week. You think about what we have this week. We have NVIDIA reporting on Wednesday. Sentiment seems to be...
That's all we have.
That's all we have. Well, we have retail earnings, to Sonali's point.
Tomorrow.
We also have Walmart. But we have sentiment at a standstill. You think about we had Microsoft and all the other big tech names go a few weeks ago, and they had a lot to say about all the money they're still spending. That should theoretically be good news for the NVIDIAs of the world.
But what happens if you run too hot?
Literally.
Too hot.
Literally too hot.
Yeah, I think that's a server issue that I imagine that they'll take care of that. And if their earnings blow away the street's expectations, no one's going to care about. We also have a bunch of Fed speakers on Wednesday. We have at least we have Mickey Bowman and Cook on Wednesday.
Yeah.
We have, I think, the ECB, which is like the European something or other.
I've heard of that one.
They're a shoe-in for a cut.
Yeah.
There's a Bank of England.
We'll see.
Governor.
Fed speak obviously matters right now as the market tries to guess what's going to happen. We heard from Powell last week saying careful about 50 different times. So we'll have to see what this brings. Let's get a check on where we stand right now, though. We'll do that with Bloomberg's Abigail Doolittle.
Well, we are looking at a nice gain for the S&P 500 after falling about 2% last week, really moderating that Trump trade a little bit, not too much. One sign of the Trump trade is the fact that crude oil below 70. Of course, the idea that there could be more drilling plus tariffs against China could slow economic activity there. They are the world's largest user of natural gas. But today, a bit of a reprieve, up 2.6%. Yields up slightly, and then Bitcoin still above $90,000 per Bitcoin. Those technicals really pretty stretched at this point. Speaking of stretched technicals, the CHIPS index, this is really interesting. On the year, we really have this index in a strong consolidation pattern. This is called a diamond top. It's basically people who bought well way back there. They want to take profits, but they don't want to take profits in a way that is going to disrupt their profit, so they do it in waves. Well, you can see the stocks below the 200-day moving average, below the bottom of this pattern. If it were to break to the downside, it should be a close to equal and opposite move lower, which was one way of saying we could see chips go significantly lower. The RSI is also trending lower. All of this as we, of course, await NVIDIA earnings on Wednesday, plus the idea of tariffs against China. Chips a bit of a poster child for the tariff situation, and some of those cap equipment companies talking about weakening demand. Speaking of chips, though, we do have one stock that has been beaten down in a big way. Today, gaining, Supermicro Computer up 10.5% as we await news of the NASDAQ delisting possibility. Are they going to submit paperwork to stay on that exchange, or might they even submit the 10K, the delayed 10K? Tesla up 7.9% on the Bloomberg exclusive that the Trump administration, the transition team, talking about the idea of that there could be something for self-driving cars, regulation that will make it a little bit easier, less regulation in a way, but rules essentially. NVIDIA down 1.2% ahead of that report and on some of the Blackwell chip news. And then finally, Mara Holdings down 3.6%. Bitcoin off of its highs, plus this company has filed for a $700 million convertible offering. Investors might not like the idea of potential dilution at some point down the road, Sonali.
Abby, thank you so very much for taking a look under the hood. And coming up next, former Treasury Secretary Larry Summers talks about sovereign wealth funds. Huge interest to Wall Street in today's Wall Street Week conversation. Stick with us for that. This is Bloomberg.
All right, it's time for our daily Wall Street Week conversation. And while more than 80 countries have a national sovereign wealth fund, the U.S. is not one of them. David Weston spoke with former U.S. Treasury Secretary Larry Summers about why the investment strategy might not work here.
There are different purposes. The usual context is when you have a country that is in surplus at the government and at the national level because of very large exports. Then you have all this huge fund, and often you can't invest it all at home, and so you want to go and invest it abroad. That's why countries like Abu Dhabi have sovereign wealth funds, countries like Saudi Arabia have sovereign wealth funds, countries like Norway have sovereign wealth funds because they have these huge oil revenues coming in, and they need to be recycled. That's why Alaska accumulated a sovereign wealth fund. The situation in the United States is almost completely different. We are running large budget deficits. We are running large trade deficits. So if we have revenue, the first thing to do with it is to stop accumulating debt as rapidly as we are. Any kind of sovereign wealth fund would be, in effect, borrowing on the federal treasury in order to go make a lot of private investments. Now, there might be a case for a targeted program to support clean energy or economic development in a depressed region, some modern version of the Tennessee Valley Authority, something like the clean energy programs we've had, and you could imagine other rationales. But a broad-based sovereign wealth fund, a kind of slush fund for government to do what it wants, achieved by borrowing money, I really don't see the logic at all.
Might it make sense, despite the fact that money would have to be borrowed to make the investment, if in fact you were reasonably assured that the interest rate on the money you're borrowing is less than what you think the investment returns will be?
I'm not sure I want the government going into a general arbitrage business. Which is what you're describing, David. And if that is a good idea, the place to start would be by taking the federal pension funds, by taking the Social Security Trust Fund, by taking the other trust funds that the government already has and investing in something that was higher return than Treasury bonds. I think there are a variety of reasons for worrying about that. When you start having government investing in companies, it starts intruding in those companies. But it'd be much more natural to start with the Treasury bonds that the government's already investing in than to set up some new kind of sovereign wealth fund.
And that was Larry Summers speaking with David Weston about the possibility of a sovereign wealth fund. I know that's a conversation that you had with John Paulson just a couple weeks ago.
It's something that President-elect Trump brought up during this Economic Club of New York speech, and of course John Paulson was very for it, one of the men behind the idea. Weirdly enough, there's actually a bipartisan bill sitting in the Senate right now that a lot of people don't know about, and it's something that had come up from both parties, as we've been talking about, bipartisan. The idea here is, and I know how much you love the conversation around pensions, but it would be the Retirement Savings for Americans Act, and it would take Americans' money, match it with government money, and then essentially create a sovereign wealth fund like you see in other countries.
Well, remember, Bloomberg reported back in September that Biden aides were working on a proposal for a U.S. sovereign wealth fund, that they were looking to create one that would allow the U.S. to invest in national security interests. So to your point that it's bipartisan, it was, something that the Biden administration was looking at.
I'm guessing not fully funded by Bitcoin?
I don't think so, but TBD, anything can happen, as we've learned.
It's kind of a Wall Street dream. If you think about it, BlackRock, Apollo, these would be the money managers at the end of the day. Maybe not all Bitcoin. There's only 21 million of them after all, Matt.
That doesn't mean the price can't appreciate, I mean, for example, what did Michael Saylor's fund? They just spent $4.6 billion, and I call it a fund, but it's actually supposed to be a company, right?
Yeah, it's just kind of the whole company. Yeah,
they spent $4.6 billion on Bitcoin. The U.S. could step in and spend $460 billion on Bitcoin.
But then you think about what the other MS told us, of course, that basically, or Novogratz, rather. There's so many Michaels. Yeah, right. But he was saying that he doesn't see it as a high likelihood that we're going to actually see a Bitcoin strategic reserve, even with all those crypto-friendly people in Congress now.
At the end of the day, it comes down to how people are going to retire and what kind of money the government of America can spend into future investment. A lot of skeptics around there.
And we already can't afford Social Security, so you want to add another one to the list.
All right, well, let's talk about ETFs next. I'm really excited for that conversation. Maybe we'll even talk about Bitcoin, too. This is Bloomberg. Well, this year's demand for ETFs is breaking records, with annual inflows already reaching the biggest on record, with still 1 month to go, maybe a little bit more than that. Joining us now is Eric Balchunas. He is Bloomberg Intelligence Senior ETF Analyst. You suggested titling this segment just "It's All Good," basically. Let's start with flows, though, because we are rapidly approaching $1 trillion for U.S. ETFs.
Yeah, no, the title was "As Good as It Gets."
Good was in there.
Great movie. Yeah, great movie. Everybody should just savor this moment because it's not just ETF all-time flow record, all-time launch record, but 96% of ETFs have a positive 12-month return.
How is that possible? Even bonds?
That's what I'm saying. Like, if you're in the 4%, you probably should just pack it up and go home. But yeah, this is up from 8% only 2 years ago. And we've seen this chart. My colleague Athanasios makes it. It doesn't really ever get higher than 96, 97%. So we're at peak everything right now, and I think it's good to just savor it. It probably won't be this good next year, but right now, man, all pistons are firing. I think the ETF industry, would it have set a record if the market wasn't so good? Like if stocks weren't up 24%? Probably not. But the ETFs are still going to take $600 billion a year in my opinion, if the market's flat or down. But I think that extra $300 billion is because everything is just like going gangbusters.
It's amazing that all of those flows going into ETFs at the same time as we crossed through $7 trillion in money market funds, which aren't yet ETFs.
Well, there's a few.
Yeah, well, by they're labeled money market funds. Their NAV isn't $1. People like the fixed NAV for money market funds, but there's a great point about the $7 trillion in money market funds. They are massive, and we have been writing about what would actually get some of that money to come out and buy equities. The good news is that still is some cash on the sidelines that could make this rally keep going. The bad news is they seem to be pretty locked in there. Like if 24% and the S&P isn't going to get you out, what will?
Well, dude, that cash on the sidelines is always there.
Yeah.
And the line doesn't turn down unless there's a total crisis. So it's never just to boost stocks.
This conversation with Steve Chiavaroni that basically it's a mirage because a lot of those, in his view, aren't investable assets, that they came from the banking system into money markets.
Well, I mean, just what could get them to come out is if rates go down. You know, if you start getting 2%, 1%, that's when they were lower, when you got nothing in a money market fund. So that was where the TINA acronym came from. There is no alternative.
If they don't fall that much, then the question is, does money really move? Here, the other question I have, though, while we have you, we were kind of joking around about how I have alerts for the tweets you put out, and this morning's did catch my eye. No, I love it. I learn something new every day, and today I learned that there have been really a record number of launches as well. Record 70 ETF launches in October, and that you're 18% already above the record for a full year. And you got weeks left to go. Are people just capitalizing on this boom? Are these successful launches?
Yeah, look, there's always been holdouts. As long as I've been covering this industry, there was always people like, oh, you know, we'll just wait till the ETF boom's over. We'll do direct indexing, or we still have mutual fund clients. It was 2021, really, I think, when the flows almost hit $1 trillion. That was the past record. That broke a lot of people. And then now we're seeing even people who are kind of have named for themselves like Tom Lee, Rubini, they're now launching ETFs because this is where the audience is. So like if you're in a band and you have an album, you're going to put it on Spotify. If not, you're kind of dumb, right? You gotta be where the people are. So this is essentially what's going on. So everything that wants to have an audience, it can be in a mutual fund too. But you kind of have to have an ETF as well so that you can fish where the fish are biting.
There are still some holdouts. You think about Barron Capital, for example, of course, top of mind since they had their conference last week. They're still mutual funds only. But I do want to talk about record launches because that's only one half of the story. You have a ton of closures, too. Not quite a record, but pretty close.
Yeah, look, there's so much spaghetti thrown at the wall. You know, it's really mind-blowing. I track this industry night and day, and I can't keep up with all the launches.
Yeah.
Some stuff just doesn't hit. You know, a quarter of ETFs are just kind of in the danger zone, and they just live in, you know, oblivion. A couple, you know, sometimes it pays to hang in there. You know, some have been rewarded just by, like, hanging on. But a lot of times, if you can't get money after 4 or 5 years, you may just pack it up, close it. Now that shelf life's even getting smaller. You know, firms are now just launching it. If it doesn't hit in a couple years, they just close up. I've got no problem with it. Better get it off the market than let someone put like a market order in for an ETF that has a wide spread and kind of get burned. I say just get rid of it. You know, chalk up your losses. It's sort of like, you know, breaking a few eggs to get the omelets.
Dude, apparently the Beatles is not on Spotify.
Really?
That's according to AI, to Google AI. The Beatles, not on there, as well as Tool.
Well, I don't know what fund structure the Beatles would be.
That's like when Capital Group came, I think. You know, when they're the Beatles of active management for sure, and they probably didn't want the ETF to be a big hit, but they came in about 2 years ago, and that was a Beatles moment because, and when they chose to go transparent, remember? And then everybody, everybody followed that, and so now I think Capital Group really paved the way for the active leaders and active managers to come in as well.
All right,
Katie knows because you guys have a
that's true.
television show together.
It's hard to say goodbye, but I'll see you in an hour.
Sure.
That is Eric Balchunas of Bloomberg Intelligence. And you can tune in to watch me, Eric, and Scarlett Fu on ETF IQ today and every Monday at 12 p.m.
I used to be on that show with you guys.
Yeah, but...
It's a brief moment.
Do you miss it?
I kind of do, actually.
Eric's fun.
But I just watched. I just sat in the third chair and watched the two of you.
That's pretty much what it's like. Yeah. In any case.
All right, coming up tomorrow on Open Interest, Florida real estate billionaire Jorge Perez of the Related Group joins us in the C-suite. This is Bloomberg.
Can I say